The market is in God mode. All-time highs, non-stop green candles. The story? AI is the new cheat code for humanity, and it's sending everything to the moon. But this isn't financial advice. If you think it is, you've already lost the game. Because under the hood, this rally is making a terrifying noise. The kind of noise you hear right before a catastrophic engine failure. You've heard the pitch.
AI is changing everything. Tech stocks are the locomotive, and they're dragging the entire S&P 500 along for the ride. It feels unstoppable, an infinite money glitch.
But here's the trillion-dollar question. Is the market writing checks the real economy can't cash? All this hype, all this optimism, what if it's just one massive hallucination? That gap between the market's fantasy and the world's reality, that's not just a gap, it's a black hole. Let's get one thing straight. The market isn't just optimistic. It's priced for absolute, flawless, divine perfection. Let's pop the hood on the engine driving this madness. It's a wild feedback loop, a self-licking ice cream cone. AI hype sends tech stocks vertical. Those companies now drowning in cash spend billions on AI servers. That spending gets counted as GDP growth. Then, investors point to that same GDP growth as proof the insane stock prices are justified. It's a perpetual emotional machine built on pure hype. But what happens when one gear in this machine shatters? Because despite the hype train, two of the most reliable, battle-tested indicators in finance are screaming bloody murder. These aren't just red flags, they're full-blown air raid sirens. First up, a favorite of the Oracle of Omaha himself, Warren Buffett. The logic is dead simple. It's a price tag for the entire US stock market compared to the country's entire economic output, or GDP. Think of it as the market's price-to-earnings ratio, but for the whole damn country. Now, to put this in perspective, a normal level is around 100%. Even at the absolute peak of the dot-com insanity, it only hit 159%. Today, we're blasting past 219%. We're not just in the red zone, we are far beyond a historical extreme. This is uncharted territory. Don't take my word for it. Buffett himself said back in 2001 that when this number gets this high, you are, quote, playing with fire. Right now, the market isn't just playing with fire, it's doused itself in gasoline and is begging for a spark. Warning sign number 2 comes from Nobel laureate Robert Shiller, the CAPE Ratio. It's a bit more high-tech. It looks at stock prices but averages out corporate earnings over the last 10 years to smooth out all the short-term noise and corporate bull. It's a reality check. The historical average for CAPE is about 17.5. Today, we're pushing 39. The only times in history the market has been more expensive by this metric were right before the 1929 and 2000 market apocalypses. That's the company we're keeping. So what happens when CAPE gets this high? History is brutal and consistent. The next 10 years of stock returns are garbage, flat or even negative. It's a forecast for a lost decade. In a world this overpriced, everyone's looking for an escape hatch, and that brings us to crypto, the ultimate narrative, the digital gold that's supposed to save you from the TradFi dumpster fire. But does the data back it up? Let's run the numbers. The promise is simple, right? When the system gets chaotic, Bitcoin is the uncorrelated safe haven that protects your wealth. An amazing idea, but it's a total fantasy. The reality is a disaster. Pitched as an inflation hedge, it crashed 65% during the worst inflation spike in 40 years. Pitched as a safe haven, it faceplants right alongside stocks in every crisis. The data shows it behaves less like gold and more like a high-risk tech stock on steroids. This is all you need to know. On days Bitcoin soars, the stock market usually does too. But on days Bitcoin crashes more than 5%, the stock market also gets dragged down to hell with it. It's not a hedge. It's a high-stakes slot machine that works great when you don't need it and self-destructs the moment you do. The conclusion is unavoidable. The data is unambiguous. Calling Bitcoin a safe haven is a lie contradicted by its actual behavior. It's not portfolio insurance. It's a high-stakes bet that the party in the stock market never, ever stops. So if the market's priced for perfection and crypto is a trap, what does the real economy look like? It's facing a gauntlet of final bosses. These aren't abstract problems. We have a national debt over 125% of our entire economy. That means the government's credit card is maxed out, no more stimulus checks. Then you have tariffs, a double whammy that kills growth and spikes inflation. And finally, crippling policy uncertainty that has businesses and consumers absolutely terrified to spend or invest. And the result of all this? While Wall Street is pricing in an AI-powered utopia, economists are forecasting that real economic growth is about to slow to a pathetic 1.4%. That's a massive disconnect. It's a chasm between the market's fantasy and Main Street's reality. So what does all this mean for you? It's about navigating the storm. It's about understanding the difference between high-risk gambling and actual resilience. The distinction is crystal clear. These are two different tools for two different jobs. Gold's role is portfolio insurance, your fortress. The data shows it holds up when things go bad. Crypto's role is a speculative rocket ship, a high-risk bet on the future that explodes when it hits turbulence. They are functional opposites. One is for defense, the other is for offense. So a prudent framework is simple. 1, assess the risk, acknowledge that valuations are at historic, risky extremes. 2, diversify, consider assets like gold that perform differently in a downturn.
3, build resilience. Focus on high-quality defensive assets that can actually weather the storm. Which leaves us with the final critical question. The stock market has placed an enormous all-in bet on a perfect AI-powered future. But with the real economy facing a storm of headwinds, the real test is what happens when the future turns out to be anything less than perfect. So what do you think is the next domino to fall? Let me know in the comments.